Joining us now is Jonathan Boyar, president of the Boyar Value Group and host of the World According to Boyar podcast. Thanks for being here.
Thanks for having me.
So I'm sure you would like it to be a stock picker's market. I guess in some measure, you can always make money picking stocks as long as you pick the right ones. How do you think about it in what has been, yes, stocks are rolling over a little bit now, but is your framework any different in what looks like a very resilient market and economy than it is at other times?
I think as best you can, you really have to drown out all that noise. I mean, if you had listened to the quote-unquote experts at the beginning of the year, you would have missed out on an unbelievable rally. So I think you have to break it down onto a stock-by-stock basis. It's obviously self-serving for a stock picker to call it a stock picker's market. I think it's a time, though, where people who know what they're doing, who do the work, who are able to do the research and can end up making a lot of money, but you have to be careful. There's a lot of minefields out there, and there are a lot of stocks that are unbelievably expensive that I would avoid, but there's also opportunity.
And so where are you, and have you already been able to see some of that opportunity be capitalized on to this point in the year?
Yeah, no, I mean, it's been a good year. I mean, a lot of our picks, fortunately, have done well, but I still think if you look at a lot of the names that we look at, let's say Liberty Braves, for example, which owns the Atlanta Braves baseball team, you know, it's $37, $38 stock. We think it's probably worth $55, $57. It has a hidden asset in the sense that it has valuable real estate that's not properly reflected on the company's balance sheet. And we think in the next couple of years it'll be sold. So there's opportunities out there. You just have to be patient, which is the hardest thing for most investors.
Yeah, although the stock has gone up a little bit. You talked about it last time you came in to see us. You mentioned hidden asset, and that's something you outlined recently in a Substack, and I take it that has been a long time method of the firm to try to find value, started by your dad,
yes.
Is that right, Mark Boyar? So basically, you look at a company, you try to find something on its balance sheet that is not necessarily visible at first glance. How does that work? How do you even go about doing that with all of the companies that are out there?
Exactly. You have to be a detective, and that's what my father, Mark, has really taught me. One of the very first stocks, he started the firm in 1975, was Tiffany & Company. Tiffany & Company, you could have bought the whole company for $30 million. That's everything. The building that it owned on 57th Street and Fifth Avenue or whatever street it was on was worth more than the entire market value of the company. But if you were just looking at the balance sheet, you wouldn't notice that because generally accepted accounting principles, which is what informs financial statements, had it at historical cost. And that's just not a relic of the 1970s. That still happens today. There are companies that have great brands underneath the corporate umbrella that many investors miss out on just simply because they just don't know what the company does. Sounds simplistic, but it works.
So one of those companies, Acushnet, and I love this one personally because my weekend warrior within me tends to pander towards one of the most difficult and painstaking sports in golf, and Acushnet is one of those companies as well.
Yeah, it's a terrible name, and I would save them millions of dollars on a McKinsey survey and say they should change the name because I took an informal poll of professional investors after we did our report and said, do you know what this company is? And no one heard of it. No one knew what they did. They own Titleist golf balls and FootJoy golf gloves, among other great brands. And that actually leads to valuation discrepancy. And we outlined that in the Substack article. That has worked out. But there are other names that still are cheap that have hidden assets. A company like IAC that owns Toro, which is a car sharing service that is on its book at historical cost, even though its stake is worth a lot more than that. So there's lots of examples. You just have to be willing to do the work, and it's one of our favorite methods to use.
And then additionally here, I mean, what differentiates, even if you look at Acushnet and say, yeah, they have a horrible name, but they still have these underlying subsidiaries in Titleist and FootJoy that in the golfers boom that we've seen kind of mid and post-pandemic now, what do they benefit from that a company in Topgolf Callaway doesn't benefit from?
They both should benefit. I mean, they're
It's very different stock charts that we are looking at over the course of this year, by the way.
Yeah, absolutely. And I think Topgolf Callaway Brands is, as ticker MODG, is at these levels a much better value. Acushnet has worked out, but I think Topgolf has different exposures because they own the Topgolf franchise, and that's been depressing the stock a little bit. But a pure play golf equipment manufacturer like Acushnet has done quite well. So the opportunity right now, I believe, is in Topgolf, but Acushnet's still interesting as well.
On the real estate side, have investors gotten more savvy? Because it feels like when you talk about the mid-70s not realizing the value of Tiffany's real estate, I do feel like it's more topic of discussion now. Oh, they haven't unlocked the value of the real estate, right? Is it tougher to find examples of that now?
That's harder. You have to be a little bit more creative. But, for example, 2009, Saks Fifth Avenue was selling below the value of the real estate it owned on Fifth Avenue, and that ended up being taken over by Hudson Bay. So these things happen. You just have to be opportunistic, and you don't have to swing at every pitch. You have to find ones that have catalysts that, if you're patient, will do well over time.
Are there any other ones that people should be watching out for?
Madison Square Garden Entertainment, which was just spun out with the Sphere, owns the air rights above Madison Square Garden, which are extremely valuable and not really reflected on the company's balance sheet. Right now, obviously, New York real estate's in the doldrums, but if you're patient and you believe that there's a reason why people will come to work every day, those air rights could be unlocked.
Are there any regulatory reasons though that those couldn't be unlocked?
I mean, it's always you have to deal with the city council,
right,
et cetera, but at some point in time, if they wanted to sell it, they probably could.